and welcome to the Dukascopy studio here in Geneva. My name's Sinead McLaughlin and I'm joined by our technical analyst Bruno Estier. Welcome back to Bruno.
Good morning, Sinead.
So 2 weeks ago there was some worry about equity correction. So where do we stand now?
Well, I think the most important thing is to realize that Europe is really outperforming in the last 2 weeks. As we see here, we have a big breakout to new highs, and this is due to the fact that the relative strength of the stocks 50 versus the S&P 500 is rising, and this comes after a long descending downtrend. And we'll see therefore also that the momentum is moving up here on both sides.
So what kind of target do we have?
Well, it always depends a little bit on the time horizon that we do have, but here if we take very long-term charts over the last 10 years, on a monthly basis, we see two things. The first one is this since 2000, coming from the left side of the chart and even further left, the big descending trend line, a dotted line, is coming through the level of 3,500 in February. And that is the juncture from the rising channel that we have since 2012. And this breakout probably will stop somewhere near 3,500 first, and when it will break and establish itself above the big descending trend line, we will probably move to 3,900 because it's the next Fibonacci levels from 3,500 and the next one is 3,900. So it usually is a relatively good target. As we see also on the time axis, this target of 3,900 can be reached by the end of 2015.
So over on the other side of the pound to the US, how is that looking?
Well, that looks still okay, though a little bit less active. We still have a rising wedge. We do have a pullback in the volatility VIX on the top part of the panel in orange, and it's still consolidating. 1 week up, 1 week down, it's still above 2025. The important things to realize is that it needs to hold above this support level that we saw mid-January and of course mid-December. These are around 2,000 level. And we wish short term that everything stays fine as long as it stays above 2025. This is basically the point that has been seen yesterday in a snowy day and probably a lack of liquidity, and there was a little pullback to that. But in theory, that shouldn't be to a big problem. However, that means this trading range that maybe we should look inside the S&P.
So you recommend looking at sectors. Which ones?
Well, first of all, let's look at the two outperforming sectors, which are utility and healthcare. The advantage of looking at these subsectors is that, as we see on the upper part of the panel, the relative strength in orange from the utility sector versus the S&P is still rising up, and this already since the beginning of December. So when there are small corrections, that's no big deal because the relative strength is compensating, if you wish, the correction. And now the utility sector is very close to make new highs. So that's a good sector to be in. The second one is healthcare, and healthcare has been outperforming, as we see on the orange dotted line, for the whole of 2014. We see it on the last 8 months. And it's making recently even new highs. And this is a good sign. Prices are still on the way up. And momentum also is on the way up for this sector, which is the best performing sector in the last year.
But how are other sectors doing, like industrial or discretionary?
Well, this is a good question, because if we want the S&P as a whole to move up, of course, we want also the offensive sector, the sector which moves when everything is good and growth is looking okay. We want this sector, like industrial, discretionary, to move up. Doesn't look too good currently. As we see, they are not really outperforming on the relative strength. It's very flat, even going down in the last few days. And we are desperately in a trading range. And therefore, we really need to hold this support level around 54. Else we might enter in a more drastic correction. But so far, it's a neutral aspect. And if we look at the discretionary, looks a little bit more positive. We see here again on the orange dotted line a rise recently in the last week, moving up, probably going to make new highs in the coming weeks. And it's also typically breaking a long descending trend line on the nominal side. So these are fine. They are coming to catch up a little bit and should help the S&P to move up.
And are there any sectors we should be aware of?
Well, there is one sector which is a little bit tricky, and this is technology. And probably we can notice that by this relative strength orange line, which was bottoming, made a new high last week, and just yesterday, with some bad news and some results, suddenly sent down this sector to the level where it needs to hold its support around 39.40. So definitely there is one sector that everybody needs to watch in the coming 2 weeks. This is this sector. If this one rebounds just on the brink, then and avoid to go down, that will be fine. If not, that might take the S&P a little bit more sideways for a longer time.
I guess then for the next 2 weeks, we'll know what to monitor. Thank you so much for joining me today,
You're
Bruno.
welcome.
Well, that's all from Bruno and myself for now. Thanks for tuning in, and remember to keep clicking back. Bye for now.